Guys, big stuff happening in the market today. Palantir reported yesterday, which we actually already did in another video. But Michael Burry is in the news and Alex Karp is in the news about the Palantir earnings. We also have McDonald's reporting earnings this morning and Novo Nordisk. So let's start with Palantir. So here's what Alex Karp blasts big short investor Michael Burry as batshit crazy for bets against Palantir and NVIDIA. But here's exactly what he said. The two companies he's shorting, the ones that making all the money, which is super weird. The idea that chips and ontology is what you want to short is batshit crazy. He's actually putting a short on AI. Guys, if you're new to the channel, it's really, really important that you hear this. If you've been around for the channel, I want to repeat this until I'm blue in the face. Michael Burry is not shorting an idea. He is not shorting AI. He is not shorting chips. He is shorting valuation. Because if Alex Karp here, what I would say to Alex Karp is, hey, Alex, if you think that this is crazy, why are you not buying your Palantir shares? Why have you been a net seller of Palantir for the last 18 months and 2 years? Why had there been no purchases of Palantir stock by any of the executives? I believe I read that recently. There had been zero purchases of stock. People buy stock for one reason. If it's so obviously a buy, why are you buying it? That's one. Two, like I said, nobody is shorting an idea. They're shorting valuation. When you say it's a terrible idea, what you're saying, Alex, is no price is too high for chips, for AI, for any of these things you're talking about. And that means Alex Karp is not an investor. He's a speculator. He doesn't realize that cash flow determines the return in the future. And if you pay too much, you'll end up with crappy returns. I talk about this all the time on our channel. I want to pull up Cisco stock because Cisco was the NVIDIA. It was the Palantir of 2000. It has yet to hit its all-time high from 2000. But yet, from this point to this point, profit is up 10x, stock price is up 10x. That's not a coincidence. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Alex Karp does not get it. No one is shorting the idea of the business. They're shorting the valuation. That's it. Now, take it personally all you want, Alex. It's not an attack on you. And guess what? Your job is to focus on running the business well. But unfortunately, you cannot determine where the price is going to be in a short-term basis. Palantir is going to go up and down in the short run, no matter what Alex Karp said. Yeah, if he comes out and says something ridiculous that might happen, it might affect the price. But at the end of the day, in the long run, what's going to drive the markets? It's going to be the fundamentals of Palantir. And I personally believe that Palantir is selling for 120 times sales, 400 times earnings, and 265 times free cash flow is absurd for a $470 billion market cap business. Guys, that's not me saying anything like absurd. It's me just sitting there saying, this is absurdly overpriced. Now, I shouldn't say that. If God came down right now and said, Paul, Palantir is going to increase its free cash flow by 200% a year for the next 30 years, this is an absolute screaming buy. Guess what happened? Nothing changed the business. The business is still going to do what it's going to do. No matter what happens to the stock price. Guess what? Alex, when the stock went from 45 here to 6 here, did he change the way in which he ran the business? No. And guess what happened to free cash flow? It just kept going up. When Amazon went from $116 a share down to $6 back in 2000 to 2003, it fell 95%. Jeff Bezos is famous for saying, but I looked at the fundamentals internally and everything was getting way better. Why? Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. I'm going to save everybody a lot of time here. If this makes sense to you, maybe you don't get it completely, but it's like, that does make sense. Subscribe to the channel. If it doesn't make sense to you, if you think I'm crazy, go away. I want you nowhere near us because you're just a cancer who's going to be awful for the guys. If you don't believe that it's possible to overpay for an idea, you are going to lose a lot of money eventually. Yeah, recently you haven't because the market's just been going up. And when the market goes up, it makes stupid people feel really smart. But I think it's ironic that some of the best investors ever have been doing the worst in the last 2 or 3 years, the last 4 years, and people don't really think to say, I wonder why that is. Because everything is detached from reality. You have a $473 billion company selling for 430 times earnings, 260 times free cash flow, and 120 times sales. That's insanity. Alex, no one is shorting the idea of the business. They're shorting valuations. You're stupid if you don't get that. And I'm not being subjective. I'm being objective. You are stupid if you think that he's shorting the idea of the business. No, he is shorting valuation because guess what? If your stock was at $4 a share again, I assure you that Michael Burry would probably be looking at it to buy it. If not already, he might not buy it because of you. And I'm not saying it to be funny. That was always my concern about Palantir, is Alex Karp is insane, and they do some weird things on the earnings side that are a little questionable. But the free cash flow looks pretty real. I just don't get why he gets so angry. All right, let's move on to another company here. One that I love dearly, that I hold near and dear to my heart, McDonald's. It's up 2% today, even though the earnings results were not good. They reported they're basically in line on revenue. They barely missed by like pennies. Earnings per share, they missed by 3.6%. They reported $3.22 versus an estimate of $3.34. And they were basically in line at $7.08 billion. But guys, you know what's interesting? Revenue, they've only beaten revenue 10 times in the last 17 quarters. Just keep that in mind. Guys, McDonald's doesn't make money from selling you hamburgers. McDonald's makes money from charging franchises fees on the hamburgers that you buy. McDonald's is a real estate business. They charge either a flat rent or a percentage of revenue, whichever is greater. That's the McDonald's method. They make a ton of money doing that. And they're a very successful franchise. When was the last time you saw a McDonald's franchise go bankrupt or go under? Yeah, they might move for a better location, but when was the last time they said, we're closing this up because it doesn't even work? We're not even, it's hard. Tim's looking at me because I think he knows of one. Do you know of one? No, he's like, Tim worked at McDonald's. Yeah. Tim worked at McDonald's. That was his first job. Was it your first job? Second job. I never worked at McDonald's, but I personally go to McDonald's every morning and get a large Diet Coke light ice. And I either get a hash brown, a sausage muffin, or a sausage burrito. Yeah, call me whatever you want. I love it. I absolutely love it. So let's see what the analysts think about. I mean, look at this growth. They have McDonald's growing $12.50 a share to $18 a share in the next 4 years in terms of earnings. It's pretty incredible. Look at that. That's a high single-digit growth rate. But revenue growth, 3, 5.5, 5.5, 5, 6%. A lot of growth. I mean, this is not a company that's a shower. It's going to sit there, and if you pay the good price for it, if you pay a reasonable price for this, you'll make good money. Look at these returns on capital. 23 and 24% over the last 1 year and 5 years. Big time stuff, guys. Big time stuff. Profit margin of 30+%, not because of hamburgers, because they get the franchise fees. They get the royalties. That's the big thing that they make money on. All right. They have a nice dividend here. Eats up. Now here's the deal. Okay. They did $7 billion in free cash flow last year. $5 billion went to dividends. That's a lot. And this company is selling for 32 times free cash flow, 26 times earnings. Listen, it's a great brand, and it's going to be around for a long time. Imagine a world 30 years from now when McDonald's doesn't exist. What would have to happen for that to be the case? It could happen, but it has to be something really big to happen for that to happen. Okay, I just said happen 8,000 times. The point is, they spend a lot of their cash flow paying dividends at 2.25%. Dividend people like that. If the stock fell in half, that becomes a 4.5% dividend, unless they cut it to save money to buy back shares, because then the stock would be selling for 16 times free cash flow. This is the way I want you thinking about investing. The change of price changes the investment. That is what Alex Karp does not understand. If I shorted McDonald's, I thought overpriced, do you think it means I hate McDonald's? No, it doesn't. But in the investing world, I shouldn't say that. In the speculation hype world, people think that making a bet against a company means you hate the company. No, it just means you don't like the valuation. That's it. Or you have inside information on some stories coming out, which, whatever. But that's what's here to understand. So the question we have to ask ourselves is, what is McDonald's worth to us? Guys, anytime you're looking at a company, before you start, I want you to come to Stock Analyzer tool. You need to use this as a way of saying, should you spend more time analyzing this business? Because at the end of the day, if McDonald's is selling for $305 a share, let's say you put it in Stock Analyzer tool, hypothetically, and it says it's worth $10 a share. Why would you spend any more time? You're not Jeremy from Financial Education where you fall in love with the story, you buy Tattooed Chef and watch it go to zero because you paid the wrong price. What we're here to do is save yourself time. Now, if your stock analyzer tool tells you the value is 400, guess what? You better spend some time researching McDonald's because it's currently selling for 300. It's the issue I have with Uber right now. Uber, I have in my stock analyzer tool at 150 as the value, and it's selling for 95. I'm sitting there going, okay, I need to pay attention to Uber here. I need to figure out what are the risks with Uber. That's the big thing here. So here are the assumptions I made on McDonald's for the next 10 years. I did 3%, 4.5%, and 6% revenue growth for the next 10 years. My low, middle, and high assumptions. Profit margin, I did 25, 29, and 35, and 23, 27, and 33 for free cash flow. I'm going to focus on free cash flow here because it's consistently below, and I don't know why. It's consistently below the profit margin. I have to understand that. So I'm going to focus on this number right here. PE. Guys, I think I'm wrong on PE. This company deserves a higher PE. 20, 23, 26. And I hit the analyze button. But before I hit the analyze button, I want you to see my desired return of 9%. This 9% is just to get the market value, the intrinsic value. It's not to sit there and say, this is the price I'm buying it at. You need margin of safety. You need to increase that 9% to an appropriate return for yourself. What's that level? Everybody's different. You might not understand McDonald's, so you put it at 15%. You might understand McDonald's very well, you put it 11, 12%. But keep in mind, this return includes the dividend. So I hit the analyze button. The stock's at 305. This is why I'm hesitant. 150 to 165 on the low side, 330 to 350 on the high side, 220 to 230 in the middle. The juice ain't worth the squeeze right now. So I'm going to add it to my watch list at, I'm going to be picky on McDonald's. I'm going to call it $225 per share. Notify me at that level. At that level, I can make an assessment, and if I like it, I can then sell puts at a lower price. So I can be paid to buy the stock at a lower price. More on that as the weeks go on. We have a class coming out about that. But that's the deal with McDonald's. Great company, great potential, going to be around for a while, but if it's the wrong price, it's the wrong price. And that's it. I don't know what to tell you besides that. Now, let's look at Novo Nordisk. They are down 3.8% today. Here's what they reported. They missed on revenue, $11.75 billion versus $11.88 billion estimated, but they crushed on earnings per share, $1.03 versus 77 cents estimated. They beat by 33%. The stock is down 3.8% today. That's what's amazing. Guys, this is a company that's worth $207 billion. Here's something interesting. Their free cash flow last year was $9.5 billion, but their net income was $17 billion. That is a big difference. I do not like that. I don't like it when the free cash flow is that different. Now, the 5-year number, $8.75 billion versus 11.2, not as big a difference, and that might be because of this one last year. So I'm going to go to our cash flow statement and see if there was a sudden increase or decrease in something. So first I'm going to go to cash, because remember, free cash flow is cash from operations less your capital expenditures. So I'm going to start with cash from operations. Okay, no, it's actually going up. You have the last few years, 7, 8, 8.5, 12, 16.75, 18.6. Now, capital expenditures. Look at this. $1.1 billion, 2.3, 6, 7.9, 9.2. There's your culprit. Now, you might sit there and say, oh, that's not good. Maybe not. Maybe it could be good, guys. They're spending a lot of money on capital expenditures. Are they building more factories to go make more of these drugs? Are they starting to do more? These are the things you have to understand. So I'm okay right now with that big, but you have to understand the capital expenditures for this company. You have to sit there and see that. Now, what I want to do, guys, is I'm going to pull up the earnings release on Novo Nordisk. Novo Nordisk increased sales by 12% and by 15%. I don't even know what that means. The Danish kroner is their currency. Operating profit increased by 5%. Now, here's what I want to do. I want to scroll on capital expenditures. I'm going to go look up capital. They didn't even have that. Interesting. Oh, this is the short one. Operating profit, net profits up 4%, EPS up 4%. Sales growth of 50, we talked about that. Let's see. So diabetes value market share. So remember, these Wegovy drugs were all originally diabetes drugs. And then all of a sudden everybody was like, yeah, I'm losing tons of weight. That's when they realized, oh, shoot, this thing works. That's what happened for like Ozempic and Wegovy. So 550 million people living with type 1 or type 2 diabetes. People with obesity. Okay, over 900 million people for obesity. Let's go see if they have anything on capital. Here's what they talk about it. Manufacturing. Upfront capital expenditures, capex, with delayed return on investment. That's probably what they're looking at here. It's like, listen, we got to go spend a lot of money on manufacturing all this stuff, but it's going to take a while. Because you can't build a huge plant in a matter of a day. It takes a while to do that. Let's see if there's anything else in here. Significant step-up capital expenditures across the full value chain to enable growth for current and future products. There you go, guys. There it is. Look at that capex. Look at that growth. Man, capex to sales ratio went from 4% in 2021 to 16%. It's going to hit their free cash flow significantly. That's something to remember, but you have to remember that could lead to significant profits. Remember, there's two different types of capital expenditures. There's maintenance capital expenditure, and there is growth capital expenditure. They're talking about growth here. They're trying to make investments today to grow the business. If that works, this will be a much bigger company down the road. So let's go back here. Let's see what analysts think about this company. All right, not much growth here, but maybe they haven't explained the story yet. But it's 11%, 9.5%, 10.8%, 11%, 12%. Let's see what this thing, I didn't even go back to these key metrics. Let me go find these key metrics. Now, by the way, guys, two reminders here. One, if you like earnings releases, if you like talking about the market and seeing videos relating to the market, do me a favor, subscribe to the channel. Two, all of these metrics here, there's a lot to consume here. I want you to be able to understand this very well because it's important, no matter if you're watching our video or you're talking about any investments, to understand these metrics. I made a very easy, quick cheat sheet for you, the key metrics PDF. It's absolutely free. Click the link below. It'll be sent to your email. You'll be able to download it here within a matter of minutes once you sign up and get that. So please do it. It'll explain all of these metrics to you, why they matter, why I look at them. So check that out. But this is a $207 billion company selling for 22 times free cash flow, only 12 times earnings. Now, guys, Wegovy, Ozempic, they're very popular right now. Like we talked about with Pfizer when the COVID vaccine was out. I was like, this is temporary. I don't know if this is temporary. A lot of people are coming out with competitor products. I don't know how secure Wegovy is versus Ozempic in terms of protecting sales. I have no idea. But the bottom line is these are expensive products that if somebody can figure out how to make it cheaper and as more competition comes in, it will make it cheaper. So even if they continue selling it, the revenue might decline. That's something to keep in mind here. But look at these returns on capital. Huge. 40% a year for the last 5 years, 30% last year. Look at this growth rate. Now they have $17 billion in acquisitions in the last 5 years. So that's factored here. But look at this growth rate. It's actually increasing. The last 3 years was 25%. The last 5 years was 20. The last 10 years was 12. Their growth rate is actually increased. We have, and here's interesting. It's rated as a buy by our community members with an average intrinsic value of 82. Wow. Okay. That is interesting. Back here to revenue growth. Analysts have it about 10% a year. 10, 10, 9.5, 10.5, 9.5. Okay. It's about 10% a year for the next 4 or 5 years. So let's go look at NVO. Have I ever done it? I have done it. So I did a 10-year analysis here. I did 4, 8, and 12% revenue growth. I did profit margin of 30, 33, and 36. I did free cash flow of 30, 33, and 36. Now, if you look right here, I'm stuck on this one. I'm going to do this, guys. I'm going to focus on free cash flow. I'm going to do 27, 30, and 33. Now, for PE, you always start at 15 or 16. You go higher for great companies, lower for bad companies. This company has high returns on capital, but maybe declining. It's got a decent growth rate, got good margins. What's the right number here? I think doing this. 16, 19, 22, but then when you do your desired return, your margin of safety, make it a little bit higher. I'm putting 9% for what would this mean for the company, and I'm going to focus on the free cash flow number. Hit the analyze button. Boom. Oh, wow. This is why people are excited. Low price of 50 to 55, high price of 150, and then middle price, look at that. Right in line with our 83 to 92. That's right in line with everybody in our community. This is interesting. So it's something to pay attention to. If this is attractive to you, you need to do more research. If you're in the community, talk to people in the community. There are thousands of people in there. I guarantee somebody's done it. Guys, thank you very much for your time. I appreciate it.